Right. Last week we were doing organic growth and we looked at the NPV method. So today we want to do another one, probably so that we can be able to do a different one. So also do NPV, payback, discounted payback, IRR, and the profitability index. Right. Would use the same document that we were using that time. This time around, we'll go to question 2. Right. We have here Mike Sports Limited is a Cape Town-based football soccer kit manufacturer and supplier. The company is listed on the Johannesburg Stock Exchange and it owns chain stores across the Southern African Development Community SADC region. MSL also offers franchise opportunities to hundreds of people to enable them to operate their own businesses. Recently, telecommunications companies have injected billions of rands into South African soccer by the way of competitions, buying existing clubs and using local stars as faces of their marketing campaigns. This has presented MSL and its peers with exciting opportunities to grow their bottom line. Hence, the recent decision by the MSL board to introduce a new soccer boot design, H7, inspired by the great soccer legend Einstein Shabalala. The following information was sourced from the integrated annual report of MSL. Right, so this is the report there. Right. Now the question is, right, we're not dealing with A, B, we're starting from number E. We'll be doing part E. Right, advise the MSL board whether or not the new machine should be purchased, assuming a hurdle rate of 19%. You can assume tax is payable in the same year as calculated in the accrued. Right, so here we're going to use what? The NPV. Remember, we said that whenever you have an open question, and if it's possible, use the NPV, unless you are told another method. So you find that in some instances, they can specify that use the NPV, use the IRR, use the payback. Or alternatively, in the passage, they can tell you that projects are only accepted if they've got an IRR of more than 15%. Then from that already, that can tell you that you should use the IRR. So here it's an open question, so we'd use the NPV. So we'd calculate the NPV of the machine. Right, we are told that I think the machine starts here on number 5. So we're starting here. To manufacture the new 7 soccer boot, MSL is planning to buy a new machine for 800,000 on June 2016. The company will use this machine for 5 years in full production and then scrap it at 50,000. All right, so that means this is a 5-year project. We have the calculation of the NPV of the new machine. Right. We have here 0, We always start with year zero. Year zero is now when we invest in the project. Year zero is now the day that we invest in the project. Then year one, we'll be talking about the cash flows that happen at the end of the year one. Year two, the cash flows that will happen at the end of year two. Year three, the cash flows that will happen at the end of year three, and so on. Right. So we have the initial investment. So all initial investment, unless told otherwise, will happen on year zero. Right. So we're told that this machine would require an initial investment of 800,000 and will be used for 5 years, whereby it will be scrapped at 50,000. So there will be 800,000 initially. And that will be negative because money will be invested. Right. Then we'll have the scrap value. 50,000 in the final year. And the scrap value will be positive because we'll be selling. So we're going to get money. Right. The expected annual production quantities of this new soccer boot for which demand exists are given below. So that's the expected demand. So they don't have a certain expected demand, but the demand can change. It can go up or down depending on what? On the situation. So they can either sell 8,000 units, the probability is 30%. Selling 12,000, it's 40%. So what you do, you calculate what we call the expected demand. For you to calculate the expected demand, you have to you multiply the quantity times probability, quantity times probability, quantity times probability, and then add up. Right. So we can say we can do our calculations here. Expected demand. So we have our quantity, probability, then expected demand. These are units. Right. We're given 8,000, 12,000, 15,000, 18,000. And the probabilities that were given 30%, 40%, 20%, 10%. Right. So to find our expected demand, we multiply this 8,000 multiplied by the 30%. Right. We do the same for all lines. So the next one will be the 12,000 times 40%, we get 4.8. Then 15,000 times 20%, we get 3,000. 18,000 times 10%, we get 1.8. Then we get our total expected demand here. Which will be 12,000. So that means we are expecting a demand of 12,000 over the period of the project. Right. So we now know our demand. So that means we'll use 12,000 as the representative demand. Right. Then we are told that the expected cost per pair is this one. Then we are told that the budgeted cash fixed cost for the production of A7 is 400,000 per annum, and the selling price is at 800 per pair. No inflationary increases are expected. So that means we don't expect any change. So just have to multiply this cost times the price. So our direct material will take the cost 465 times the expected demand, which we have calculated here, which is the 12,000. What do we get? Thank you. 5,580,000. So every year, this will be negative 5,580,000. They said they were not expecting any inflationary prices. But if there's inflation, I think you remember from last week what we're going to do. Right, then we have got them direct labor, which is 200. So they've direct labor, which will be 200 multiplied by 12,000. What do you get? Thank you. 2.4 million. Right. Then we have our variable overhead, which is 50. Multiplied by 12,000. What do you get? Thank you. Right. So say 600,000. Then we know that the budgeted cash fixed cost for the production of H7 is 400,000 per annum. Right. The fixed cost, you should be very careful because sometimes it might include things like depreciation. So if it includes depreciation, we'll take out the depreciation. Why? Because depreciation is a non-cash item. Depreciation is a non-cash item. But in this case, they said we are not going to take out to think about depreciation because they specifically mentioned that these are cash fixed costs. That means they don't include non-cash items. So to take them as they are, that means cash fixed costs 400. Right. Then we are told that the selling price is 800 per pair. The selling price is 800 per pair. Remember that our pairs are 12,000 from our expected demand. So our sales 800 multiplied by 12,000. What do we get? What do we get? 9.6 million. This one is positive. Right. Any questions? Right. If we don't have any questions, then we'll check the other things then. The following options are available to finance the new initiative. Right. We don't look at the financing part when we are dealing with the NPV. We don't include the financing part. The financing part will be part of the cost of capital that will be used to discount the project. Right. The South African income tax stipulates a company tax rate of 28% and a Section 12C allowance on the new manufacturing machine of 20% per annum. The prime lending rate is currently 10.5% and is expected to stay unchanged for the foreseeable future. All right, so we'll have our income tax expense. Right. Let me do a calculation of income tax expense somewhere here. Right. Right. Then I will take our costs and expenses. We don't include the initial investment and initially the script value, we don't take it, but we're going to include it. All right, so I just extracted I think I made a mistake here. Right. Right. Right, so I'll just take the incomes and expenses here. Right, so I just took the incomes and expenses. The initial investment is not recognized as an expense in 1 year. It will come in as wear and tear. And for you to get that wear and tear, you have to understand how SARS are treating the wear and tear. So that's what we're given at the bottom here, that in the Section 12C allowance on new manufacturing machine of 20% per annum. So there's 20% per annum wear and tear. So say wear and tear here. So wear and tear does not come into the main answer. It comes in the calculation of tax. which is remember the machine is 800,000 times 20%. What do we get? Thank you. Thanks, guys. Right, then we get sorry, we have our recoupment. Right. And again, you should be very careful. When they say 20%, you have to check it how many years. If it's 20%, that means it's over 5 years. Where is the 5 years? 100% divided by 20%, we get 5. So they're allowing over 5 years. So that's the 5 years there. Right. So we'll have our 5 years. Then that means by the time that we reach 5 years, the asset will be fully provided for in terms of wear and tear. That means its value will now be 0. So the total amount of the sale, the scrap value will be recoupment, 50,000. But let's say they sold it in the 3rd year. The value was going to be 800,000 minus 160,000 times 3. So you're now going to compare the tax value to the scrap value to see if there's recoupment or scrapping allowance. There's recoupment if the selling price is more than the tax value. Like in this case, the tax value will be 0 by year 5. So when they sell for 50,000, the full amount will be recoupment. But if you sell at less than the tax value, then there will be a scraping allowance. A scraping allowance will be subtracted for tax purposes. So this one is it's a recoupment, so we have to add it. It's a taxable income. Right. Then we get the taxable income of the entity. Right. Then we get our income tax at 20%. Right. Now to get our the income tax expense, we simply multiply the taxable income times the income times the tax rate. So that will be equal to so this will be our income tax expense. Right. Any questions on the income tax expense? So then we export it to this side. And we subtract it because it will be money going out. Right. Then we get our, yes.
Can I just find out if when on the calculation, say for instance, when you did that calculation before you did the income tax, you had a negative. So when you multiply, and then
there are 2 options. Either you take it as a tax benefit, but if there's no instruction, a tax benefit you would add. But if there's no instruction, you carry over the negative cash flow to the next year. Remember that if you've got an assessed loss, SARS, they don't normally pay you, but you can claim that as a deduction in the next year. Like, for example, if this was negative 128, sorry, negative 460, then we're going to put it on year 2 as a minus. It will reduce the taxable income for the second year.
Okay, thanks.
So if there is no other instruction to the contrary, a negative taxable income or what you call an assessed loss should be included in the following year as a deduction. Right. Then we get our net cash flow for each year. Right, is that fine? Right. Then you then use your discount rate to discount these cash flows. Right. So we're going to say we've been told that discount rates we've been given. But otherwise, you know that in most of your exams, they would first ask you to calculate the weighted average cost of capital. Like your answer to this part should have been your percentage, but in this case, you were not going to use it. You would use this one. So in most exams, if they ask you the work first, then they don't tell you how you are going to, if they don't give you a discount rate, you know that you are supposed to use your work. So you then have to use your work. Right, but if they specifically tell you, like in this particular question, we have been specifically told that we should use a redo rate that is given of 19%, then use that 19%. So in this case, we're going to use the 19%. Any questions there? Or maybe, so if they tell you that the project is being funded entirely by a loan from FNB, so you ignore your work, you use that the cost of that loan from FNB. Or if there are multiple sources, you just have to find the work of those sources that are being specifically used for that project. All right. So our discount rate is 19%. Then our net present value. We can then use our financial calculator. As I said, that if you have a challenge with your financial calculator, you can contact me. But I saw nobody contacted me. That means all of you are comfortable with your financial calculators. I will use Excel here. So that will be our answer. So this is our net present value. Right. Then you don't just calculate the net present value. You also have to make sure that you conclude. You give a conclusion that the new machine be purchased as it results in a positive net present value. So if the NPV was negative, then we're going to say they should not invest in the machine. Any questions? All right, so today I also want to show you the other methods, but we use the same data so that we don't waste time. All right, let's assume that the question was about the payback period. The payback period, this is the period that it takes to recover your initial investment. So we're saying the company will be interested in when would their money be received back. That will be their major interest. So they'll be interested in when, by when should will the money be back. All right, so we can say here, cash flow, cumulative cash flow. Right. We'll start with year 0. You will be taking these cash flows here. So we'll start with 800,000 negative. Right, the cumulative cash flow is the total cash flows added together. That is from year 0 up to the year that you are looking at. So here it will be 800,000. Then in year 1, right, we know that our cash flows for year 1 up to year 4 are the same. It's 491,200. Right, so we'd say 491,200. Right, to get your cumulative, you now say this negative 800,000 plus the 491,200. Right, so that means by year 1 we'll have recovered 491,200, and we still need 308,800 more. You go to a year 2, our cash flow is 491,200. Right, then you get your cumulative cash flow. Now it's now positive 182,400. Is that correct? C115 plus B 116. I think that's okay. Right. Now, the moment it becomes positive, you don't have to continue. That's the end of the calculation. So your payback period. So that means our payback period will be equal to 1 plus 1. You take it from the year that it was negative for the last time. It was in year 1 negative for the last time. Then plus, you take the negative NPV 308,800, the last negative NPV, then divide by the cash flow for the year that it became positive. The cash flow for the year that it became positive. So the 1, you take the year that it was negative for the last time, which was year 1. Then the 308,800 is the last cumulative cash flow to be negative. The last cumulative cash flow to be negative. Then our 491,200 is the cash flow for the year when the cumulative cash flow became positive. All right, so that will give us 1 point what? Can you just give me to 4 decimal places? All right, thank you. Can you give me maybe just add the decimal places, maybe to just make them, let's say, 4 decimal places, I think, so that it can be more accurate. Right, 1.6287. Thank you so much. So that's 1.6287. Yes. That means that's how long it will take to recover the money. But in other exams, they can ask you that express it in years and months. To make it years and months, we would say 1 year, then 0.6287 times 12 to convert that to months. So to get 1 year, again, can you give me the months to 4 decimal places there? If you say 0.6287 times 12, what do you get? 1 point, okay, sorry. I want the 0.6287 times 12. 7.5444 months. And if you want to express it in years, months, and days, it will be 1 year, 7 months, then 0.5444 multiplied by 30. We just assume that the average days in a month are 30. So that means that would be 1 year, 7 months, and can you find 0.5444 multiplied by 30? So we can then say 17 days. Someone can ask why it's 16.33, why did I say 17? The 16 days, they will not have paid back. So the paying back will happen in the 17th day, which is the third of the 17th day. It's within the 17th day. All right, so it's 1 year, 7 months, and 17 days. But if they don't ask you to convert into days, if they just say calculate the payback, you just end on 1.6287 years. You can just say 1.63 years. Then that will be fine. Right. Any questions? All right. So that will be our payback. So what you do now, you then compare the payback that you get to a criteria that you set as a company. As a company, you can say, for example, we accept all projects that have got a payback of 2 years or less. So this one will be less than 2 years, then you accept. Or maybe you just want a payback of 1 year, then you reject this project because it's more than a year. So how you judge whether to accept or reject this project depends on the criteria set by the company. So that criteria, it depends on whether you're a risk taker or you don't like risk. Those who don't like risk would want a very short payback period of time. Actually, this method is usually used by those who don't like risk, who are interested in how when their money will come back. Whatever happens next, they don't mind. Whatever will happen in year 3, year 4, year 5, they don't mind. So the advantages of this method is that it reduces risk. You accept projects that will pay you daily. But the disadvantage, it doesn't take the time value of money. As you saw, that it was just taking the cash flows as they are without taking into account the 19% cost of capital. And it doesn't take into account everything that happens after year 2. Because you can accept a project based on 2 years, but then after year 3, it's giving 6 cash flows. So that is the disadvantage of this method. That's why it's not very popular. But if you are not, if you don't like risk, it can be a useful method that can be used to determine the acceptability of a project. Right. Any questions? No questions. Then we'll move on to the other methods. Determine how long in years it will take to recover its initial capital investment using the discounted payback period method. Right. We said one of the disadvantages of the payback period is that it doesn't take into account the time value of money. So we've got another modified method that will now take the time value of money into account, which is the discounted payback period. So with the discounted payback period, we're now saying, so it's just the same method, but now this one will now take into account the time value of money. We'll now say, yeah, right, we have our cash flow. Then we have our discount factor at 19%. Then we'll have our discounted cash flow. Then we'll have our net present value. Right. We have here 0. Our cash flow would be negative 800,000. The discount factor in year 0 will always be 1. The discount factor in year 0 will always be 1. It will always be 1, always. Because 1 rand today is just 1 rand. It doesn't change because the investment is done now. Then your discounted cash flow, you multiply your cash flow times the discount factor. So not net present value here, it's a cumulative discounted cash flow. Right. So that would be negative 800,000. The cumulative, we are just doing the same that we're doing on the other question. Right, year 1, our cash flow, we know that from year 1, our cash flow up to year 4 is 491,200. So just like the payback period, you end when it becomes positive, the cumulative cash flow. Right, your discount factor now. Let me just show you here how to calculate your discount factor for each year. We know that 19% is our hurdle rate. So to calculate our discount factor for year 1, you would say 1 divided by 1.19. 1.19 is coming from 100% plus 19%, which is a 119%. What do we get to 4 decimal places? 0.8403. Thank you, guys. So it says 0.8403. Right, then our discounted cash flow will multiply now. The cash flow times the discount factor. We get this amount. Then to get our cumulative cash flow, we just do the same way that we did that at the time. That means this negative 800 plus this 412. That will be our cumulative cash flow. Then we go to year 2. As long as it's negative, we go on to the next year. 491,200. Our discount factor, right? So this one was 0.8403. Right. In our second year now, we'll now say 1 divided 1.19 to the power of 2. So the power will be the year squared. What do we get? $0.7062. So 0.7062. Right. Our discounted cash flow will now be, it's just the same. We multiply. Right. Then our cumulative cash flow again, we do the same way. It's still negative. So we'll continue to year 3. This would be 491,200. Right. In the third year, we'll now say 1 divided by 1.19 to the power of 3, because it's year 3. What do we get? Thank you. So that will be 0.5934. 5934. So we'll have 0.5934. Right. It's now a positive. So that will be the end of the calculation. So our discounted payback would be 2 years. Then he would say 40,359 divided by 291,478. That will be 2 points. Can you give me what you get from that division? Thank you. So that means 2.1385 years. Then we can say 2 years. If they want in months, can you just say 0.1385 multiplied by 12? We'll get 2 years and 1.62662 months. Then we can say 2 years, 1 month, and then we say 0.662 multiplied by 30, the number of days in a month. So you get 2 years, 1 month, and what do we get? We can say 20 days. So this will be our discounted payback. So you'd find that your discounted payback is more than the what? Than the plain payback period. Because it will now, all future cash flows will now be discounted. Any questions?
Yes, question please.
Right. So that will be our discounted payback. So to interpret it, it will also depend on here they just wanted in years, so there was no need to do everything else that we did to convert to months and days, but I was just showing you in case. Right. Then we can also use what we call the profitability index. Right. You might find that a project can have different cash flows, a different initial investment. So it might be unfair for us to just use the NPV. So we can calculate what we call the profitability index. Now to calculate your profitability index, that means first of all you have to calculate your NPV. So it will be the initial investment plus your NPV over your initial investment. Right. Projects are accepted if profitability index is more than 1. And projects are rejected if profitability index is less than 1. So the profitability index for this project that we're looking at, it would be, right, the initial investment, we know that it's 800,000. The initial investment, we know it is 800,000. Right, the NPV, we know that it's 716,996. So to say, $716,996. What do we get? $1.8962. So we can just say 1.896. So our conclusion would be accept the project. As profitability index is more than 1. Right, but if you are dealing with mutual exclusive project, that means more than 1 project, you would accept the project with the highest highest profitability index. Any questions? Right. Then the last method, internal rate of return. The internal rate of return, we're saying a project is accepted if IRR is more than the cost of capital. And it is rejected if IRR is less than cost of capital. So like in this case, we'll be saying as long as the IRR is less than 19%, we reject. If the IRR is more than 19%, we accept. So, right, we've got cash flow 0, which is equal to what? 800,000, the initial investment. Cash flow 1, which is equal to, I remember that in cash flow 1 to this, it was 491,200 up to year 4. So it'd say 491,200. So whether you are using the NPV profitability index or IRR, you still have to calculate your cash flows first for each year. Even the payback, but only that the payback, you won't use all of them. $510, no, 527,200. That's the last one. Then you find your IRR. You use the financial calculator. There is the table format, but it takes a lot of time. So we normally don't recommend that for the exam. All right, let me just do it here. Please, if you don't know how to use your financial calculator, feel free to inbox me, then we can be able to assist each other. And make sure that you do that before exams approach. Which is 54.76%. So your conclusion would be the project should be accepted as the IRR is more than the cost of capital of 19%. So you'd find that if you are just considering one project, the conclusion that you get on NPV will be the same as the conclusion on profitability index, and also as the conclusion from the IRR. Because when a project has got a positive NPV, it will also have a profitability index of more than 1. And it will also have an IRR, which is more than the cost of capital. And the opposite also applies, that when a project has got a negative NPV, the profitability index will also be less than 1, and the IRR will be less than the cost of capital. So the conclusions reached, if you are looking at one project, will be always the same. But when you are looking at multiple projects, they will be different. All right. Any other questions? All right. If we don't have any questions, then next you can just practice. You can even use the third question to practice to see how to do these methods. So next week we'll be looking at mergers and acquisitions. Next week we'll be looking at mergers and acquisitions. I will send you the document most probably when I send the recording that we'll be using. So you just read the theory on it. Then because of the time, I will just explain the concepts as we use the questions. Remember that you are writing next month, the dates are already out. And along the way, I think I would include the additional revision classes, usually during the weekends. I'll be telling you as we go. Thank you so much, and God bless you richly. Have a blessed night.
Thank you.
Thank you.